In this last video of Learning Set 4, Unit 1, you're going to learn about assets, liabilities, and debt-to-income ratio. In this first example, we're looking at assets versus liabilities. Assets, this is something of value that you own. Liabilities, these are amounts that you owe others. So Liam Brown is single, in his mid-20s, and owns a condo in a big city. He has calculated the following assets and liabilities. So if you look at examples of assets, his condo, his car, his checking account balance, this is money that he has on hand or property that he owns. The liabilities would be the amount he owes on his mortgage. So, for example, if you look at the asset of the condo, it's $580,000, but he still owes $380,000 on the mortgage. So he's only got part of the value. Student loans he owes and credit card debts would also go under liabilities. So we want to calculate Liam's net worth. Last year at this time, he calculated his net worth at $205,780, and we want to compare both values. What do the changes mean? So first off, we need to find the sum of the assets. So we need to add everything listed under the assets section. Okay, so we need to add to get the sum of the assets. And it winds up being a total of $673,180. We next need to find the sum of the liabilities. This is what we owe. So we look at the right side of the column and we want to find the total liabilities. So that would be adding everything to find the total liabilities. And that gives us a total of $432,600. So right now, it's looking good. His assets are bigger than his liabilities. So that's a good thing. That means he has more money than he's spending out. So to find the difference, you just subtract the two, and he's got $240,580. So his net worth this year would be $240,580. And if we go back up and look, his net worth last year was $205,780. And if we subtract, we get a total of 34,800. Now, this is this year and this is last year. So if you compare the two, you see that this year's current net worth is higher than last year. So he had an increase of 34,800. So if Liam wanted to continue improving his net worth, he could do a couple of things. So one of the things he could do is he could increase his savings, because by increasing your savings, your money amount is getting bigger. And the other thing he could do is pay down his debt. So if you don't owe as much liability or money to other people, then that also increases your net worth. So Tome's monthly liabilities and assets are shown in this table. And we want to find his debt to income ratio. So when I say debt to income, think of it as if it's a fraction. So you want debt to income. So debt divided by income is the ratio. Okay. So debt divided by pre-tax income. So to do this, we first have to total our liabilities, which is our debt, and we have to total our income. So when you add them together, the total debt is $3,400. The total pre-tax assets is $8,300. You put them in your ratio with the debt on top and the pre-tax income on the bottom, divide, and it leaves you with 0.4096. So that tells us it is approximately 40.9% is his debt to income ratio. So that is actually pretty high. And when you go and look for loans, or you try to get credit cards, they are going to look at your debt to income ratio. They'll take and figure out how much debt you owe and will divide it by the income and determine whether or not you're a good risk for them to loan money on. Okay, so Tom anticipates that next year his car and student loans will have been paid off, and he will have received 10% salary increase if everything else remains the same. We want to recalculate the debt to income ratio. So if we look at this, his car and student loans will have been paid off. So that means this amount changes and this amount goes away because he will now have less liability. So his new debt would be 2,300 plus 200, a total of 2,500. He will receive a salary increase of 10%. So that means this amount increases and we have to calculate it to figure out what our new income is going to be. So I did that right here. So I took his 7,800, multiplied it by 10% in decimal form. So he gets an increase in his salary of $780. Add it back in. His new salary is 8,580. So we need to re-add that amount up here to get the new amount. So if we were to add this up here, we would need to take and replace this with 8,580. And then if we added it up, 0, 8, 16, 18, 1, 6, 9, 10, 1 is 9,080. Calculate our new debt to income ratio, our new debt on top, our new income on the bottom, and we are now have a 0.275, which is 27.5%. You would be a much better risk for a loan or a mortgage if you had this low of a rate.